Here's something that should make you uncomfortable. While you were sleeping last night, silver quietly crossed a threshold that nobody saw coming just 12 months ago. The number is staggering, 134%. That is how much silver has climbed since January, and gold just shattered through $4,400 per ounce. If you have been paying attention to your portfolio, your retirement accounts, or even just scrolling through financial news, you have probably felt that nagging question creeping in. What does this actually mean for people like us? Not for the hedge fund managers or the Wall Street traders, but for those of us who have worked decades to build something solid and who are now watching the entire financial landscape shift beneath our feet. I'm not here to sell you silver. I'm not here to tell you this is your last chance before some imaginary deadline. What I am here to do is walk through what is actually happening in these markets right now, why it matters, and most importantly, give you a clear way to think about this so you can make decisions that fit your situation. If that sounds valuable to you, go ahead and subscribe to Element Axis right now. It costs nothing, but it tells me you want more straight talk about markets without the hype or the fear-mongering. And honestly, the conversations we have in the comments section are often more valuable than the videos themselves, so stick around for that. Let me set the scene because numbers without context are just noise. Gold has pushed past levels that seemed impossible 2 years ago. Silver has more than doubled in 12 months. Financial headlines are throwing around words like unprecedented and historic and generational opportunity. And depending on where you look, you are either reading that this is the smartest move you could make right now, or you are reading that this is a trap waiting to snap shut on anyone foolish enough to step in. Here's what I think. Both sides have pieces of the truth, but neither one is telling you the complete story. And the incomplete story is exactly where people lose money. So what is actually driving this move? Because if you do not understand the forces pushing prices, you cannot possibly evaluate what might happen next. The first major force is something we have all been living through, macroeconomic uncertainty. And I am not using that as some vague catchphrase. I mean something very specific. The labor market has been cooling down. Inflation has been stubbornly hanging around, sitting about a full percentage point above where the Federal Reserve wants it to be. And everyone in the financial world is locked into this exhausting guessing game about what the Fed will do next with interest rates. When people think the Fed might keep rates higher for longer, precious metals tend to struggle because higher yields make cash and bonds more attractive. The cost of holding something like gold or silver, which does not pay you interest, becomes harder to justify. But when the narrative shifts, when people start worrying about slowing growth or rising recession risk, everything flips. Suddenly, investors stop focusing on the next Fed meeting and start looking at the bigger picture. And when the Fed looks like it might be done raising rates or might even start cutting, two important things happen for precious metals. First, there is what I call monetary hedge demand. People start looking for protection against policy mistakes, against inflation coming back, against financial stress. Gold has played this exact role for thousands of years. This is not new territory. Second, there is a risk appetite shift. When liquidity expectations improve, traders become willing to take on more volatile positions. And silver, which acts as both a monetary metal and an industrial commodity, tends to catch that wave even harder than gold. That is part of the reason silver is up 134% while gold is up around 70%. Silver is playing both roles at the same time. Now here's the part that most people are not talking about, and it might actually be more important than anything the Fed does. The dollar. Not just what happened last week or last month, but what has happened over the entire first half of this year. According to recent reports, the dollar dropped about 11% against other currencies in the first 6 months of 2025. That is the biggest decline in more than 50 years. Let that sink in for a second. 50 years. We're not talking about normal market fluctuation here. We're talking about a historic repricing of the world's reserve currency. Why does this matter for gold and silver? Because these metals are priced in dollars. When the dollar weakens, it takes more dollars to buy the same ounce of metal. Simple math. But there's something deeper happening here, something that connects to a much larger shift in how the world views the dollar as a store of value. What is driving this dollar weakness is not just interest rates or trade balances. It is structural. Investors and institutions around the globe are looking at changes in economic policy, political pressure on the Federal Reserve, debt levels, deficit spending, and many of them are reaching the same conclusion. They are significantly underinvested in alternatives to dollar assets. One analyst recently put it bluntly, many investors realize they are significantly underinvested in gold. That is not a prediction about where prices are going. That is a statement about portfolio positioning. And when large pools of capital decide they need to rebalance toward hard assets, the buying pressure can be substantial and it can last for years. Before we go further, let me ask you something. Drop a comment right now and tell me what percentage of your portfolio was in precious metals before this year. I am genuinely curious whether you were ahead of this curve or whether this move caught you off guard like it did most people. And while you're in the comments, tell me what city or state you're watching from. I love seeing how far this community reaches. Now, I want to talk about something that gets mentioned constantly but rarely explained properly: geopolitical uncertainty. Almost every analysis you read mentions tensions between major powers, military actions, political instability. And yes, these things matter. They create the kind of fear and uncertainty that historically pushes capital toward safe haven assets. But here's my issue with how this story usually gets told. Geopolitical uncertainty is almost always present. There's always something happening somewhere that could theoretically destabilize markets. The real question is not whether uncertainty exists. The question is whether the current level of uncertainty is being priced appropriately or whether markets are overreacting. Research shows that gold moved higher during 7 of the last 9 major stock market sell-offs going back to the late 1980s. That is a solid historical pattern. But patterns can be over-relied upon. Just because gold tends to rise during crisis does not mean it will rise during every crisis. And just because gold is rising now does not automatically mean we are in a crisis. Sometimes prices move because of positioning, because of capital flows, because of technical factors that have nothing to do with the narrative being sold alongside them. This is why I keep emphasizing frameworks over predictions. A prediction tells you what will happen. A framework helps you evaluate what might happen and prepare for multiple scenarios. So let me give you a framework for where we might be right now. One analyst described it this way: we are probably in the 8th or 9th inning of this boom cycle in gold and silver markets. If you are not familiar with baseball, that basically means we are late in the game. But here is what he said right after that, and this is important. Even if we are in the 8th or 9th inning, a lot of runs could still be scored. That is actually very honest and useful framing. It acknowledges that the easy gains have probably already been made. The people who bought silver at $22 or gold at $1,800 are sitting on massive returns. But it also acknowledges that late-stage moves can be powerful. If this becomes what traders call a blow-off top, some of the most explosive price action of the entire cycle often happens right at the end. The problem is that late-stage moves are also where the most damage gets done to people who enter without a plan. Volatility cuts both ways. The same conditions that produce rapid gains can produce rapid losses. And if you're buying near all-time highs without understanding your time horizon, your risk tolerance, and your overall portfolio, you're not investing. You're gambling. And I say that not to scare you, but because I want you to succeed with whatever decisions you make. If you are getting value from this breakdown, do me a favor and hit that like button. It helps more people find this content, and it tells me what kind of analysis resonates with this audience. Let me shift gears and talk specifically about silver, because silver is not just a monetary metal. It is an industrial metal, and that industrial demand story is being fundamentally reshaped by the green energy transition. Silver has physical properties that make it essentially irreplaceable in certain applications. It has the highest electrical conductivity of any element. It has thermal conductivity, reflectivity, antimicrobial properties that make it critical for a range of technologies. The biggest industrial demand drivers right now are solar panels, electric vehicles, electronics, advanced infrastructure. Photovoltaic cells need silver for their conductive properties. As solar installations scale globally, manufacturers are pulling more silver out of the market every year. Electric vehicles and their charging infrastructure are loaded with electrical components that rely on silver. Circuit boards, connectors, 5G infrastructure, smart grids, the list goes on. Here's the key difference between gold and silver. Gold mostly sits in vaults and jewelry after it is purchased. Silver that goes into industrial applications often does not come back to the market. It gets consumed in a way that gold does not. And if the trend toward electrification and clean energy continues, which most analysts expect it will, the structural demand for silver is only going to grow. This creates an interesting dynamic. In a strong growth environment with heavy green spending, industrial demand can supercharge silver's performance. But in a sharp global slowdown or manufacturing contraction, that same industrial exposure becomes a liability. Silver can underperform gold during recessions, specifically because its industrial demand falls off. So when you are evaluating silver, you have to ask yourself what you are really betting on. Are you betting on monetary demand, the idea that silver benefits as a hedge against currency problems and inflation? Or are you betting on industrial demand, the idea that electrification will drive structural consumption growth? Or are you betting on both? Your answer should inform how you size your position and how you think about time horizons. If you are primarily interested in the monetary hedge, gold might be the cleaner play. If you are interested in the industrial story, silver makes sense but comes with more volatility. Share this video with someone who might be thinking through these same questions. Chances are you know someone who is wondering what to do right now, and this framework might help them too. Let me talk about one of my favorite analytical tools for precious metals, the gold-silver ratio. This simply measures how many ounces of silver it takes to buy 1 ounce of gold. When the ratio is high, silver is cheap relative to gold. When the ratio is low, silver is expensive relative to gold. Historically, when the ratio stretches to unusually high levels, it has often signaled that silver is undervalued. That setup has repeatedly attracted long-term buyers who quietly accumulate silver, betting that either silver will catch up or gold will lag. Over the past several years, the ratio spent a long time in historically elevated territory that kept the argument alive that silver was undervalued versus gold. This year, we have seen some compression as silver has outperformed. The question now is whether that compression continues or whether we are due for a reversion. I'm not going to tell you which is more likely because I genuinely do not know. Anyone claiming certainty about the near-term direction of the gold-silver ratio is either misleading you or misleading themselves. What I will tell you is that the ratio is a useful tool for thinking about relative value, but it is not a timing mechanism. It can stay extended in either direction longer than most people can stay solvent. Let me pause and ask you something. What is your current allocation to precious metals? Has it changed this year? Are you someone who has been stacking for years and this move validates your approach? Or are you watching from the sidelines wondering if you missed it? Drop that in the comments. I genuinely want to know the range of perspectives in this community. Now let me address what everyone is thinking, but few people want to say out loud. Is it too late? Silver is up 134%. Gold just hit all-time highs. If you did not buy earlier, have you missed the move? Here is my honest answer. I do not know, and neither does anyone else. But let me give you a framework for thinking about it that is more useful than a simple yes or no. First, ask yourself what you are trying to accomplish. Are you trying to trade this for short-term profits? Or are you trying to build a long-term position in hard assets as a hedge against currency problems and systemic risk? If you are trying to trade, the game is much harder at these levels. You are competing against algorithms, institutional players with better information, market makers who can see order flow. Trading near all-time highs requires precise entries, tight stops, and the discipline to take profits when the setup works. Most retail investors do not have the skills or the emotional control to do this consistently. If you are trying to build a long-term position, the math is different. Over a multi-year or multi-decade horizon, the question is not whether you bought at the exact bottom. The question is whether the fundamental thesis is intact. And the fundamental thesis for precious metals, that fiat currencies tend to lose purchasing power over time, and that hard assets serve as a hedge against that, has not changed. I think the more useful question is not, is it too late? But rather, how do I position responsibly given where we are? And for that, let me suggest a framework. First, know your time horizon. If you're investing for 20 years, buying at all-time highs matters much less than if you are trying to flip in 3 months. Most anxiety around timing comes from people with short-term horizons, pretending they have long-term conviction. Second, size appropriately. This is not the time to go all in on anything. If you are allocating to precious metals, do it in a way that lets you stomach a 30 or 40% drawdown without panicking. Because drawdowns happen. They are part of the deal. If your position size is so large that a normal correction would force you into emotional decisions, you are positioned too big. Third, understand what you own. Physical metal is different from ETFs, which is different from mining stocks, which is different from futures. Each has different risk profiles, different liquidity, and different counterparty exposure. Make sure you understand what you are actually holding and why. Fourth, have a plan for multiple scenarios. What will you do if silver goes to 50? What will you do if silver drops back to 25? Having these answers ahead of time, before the emotions hit, is what separates disciplined investors from people who become exit liquidity for others. I want to talk about one more thing that seldom makes it into mainstream coverage: volatility itself. Throughout this entire move, volatility has been elevated. Gold and silver are not drifting calmly higher. They are surging, pulling back, surging again. The daily and weekly swings are large enough to shake out anyone without conviction and generate both euphoria and despair, sometimes in the same week. This volatility is not a flaw in the system. It is how these markets work, especially at turning points. And here is what most people get wrong about volatility. Volatility is not the same as risk. Risk is the probability of permanent capital loss. Volatility is just the magnitude of price swings. A volatile asset can be low risk if you have a long time horizon and appropriate position sizing. A stable asset can be high risk if it is fundamentally overvalued or if you are overleveraged. The reason I bring this up is because I see too many people get shaken out of positions, not because their thesis was wrong, but because they could not handle the volatility. They buy, the price drops 10%, they panic sell, and then they watch the price recover and run to new highs without them. This is one of the most common ways retail investors destroy their own returns. If you're going to participate in precious metals, you have to make peace with volatility, you have to expect it, you have to plan for it, and you have to have rules in place that prevent you from making emotional decisions during the scary moments. Let me give you a practical example. Say you decide you want to allocate 10% of your portfolio to silver. Instead of buying that entire position at once, you might scale in over 6 months. You buy a third now, a third in 2 months, a third in 4 months. This way, if the price drops after your first purchase, you are actually pleased because you get to buy more at lower prices. And if the price keeps rising, you still have exposure to the move. This is not magic. It is just a way to structure your approach so volatility becomes manageable rather than terrifying. We are living through a genuinely historic moment for precious metals. The numbers are undeniable. Gold at 4,400, silver up 134% in a year, the dollar experiencing its worst first half in 50 years. These are not normal conditions, but historic does not mean easy, and historic does not mean guaranteed. Markets can stay irrational longer than you can stay solvent in both directions. Just because something should happen does not mean it will happen on your timeline. What I want you to take away from this is not a prediction about where gold and silver are going. I genuinely do not know, and I am skeptical of anyone who claims they do. What I want you to take away is a framework for thinking about this space that will serve you regardless of which direction prices move. Understand the macro forces, the Fed, the dollar, the geopolitical landscape, the industrial demand story. These are the currents moving the ocean. If you do not understand the currents, you're just floating and hoping. Understand your own situation, your time horizon, your risk tolerance, your existing portfolio construction. The right answer for someone in their 30s with decades ahead is different from the right answer for someone approaching retirement. Understand the nature of the asset. Precious metals are volatile. They go through boom and bust cycles. They can draw down significantly even in structural bull markets. If you cannot handle that reality, this might not be the right asset class for you. And finally, stay humble. The market has a way of humbling people who get too confident in either direction. The people screaming that silver is going to 200 might be right, or they might end up holding the bag. The people screaming this is all about to collapse might be right, or they might watch from the sidelines as the move continues without them. The honest answer is we do not know, and that uncertainty is not weakness. It is acknowledgement of reality. The best we can do is prepare for multiple scenarios, size our positions appropriately, and make decisions based on process rather than prediction. Before I let you go, I want to hear from you. What is your take on this move? Are we in the late innings of a boom cycle, or is this just the beginning of a much larger repricing of hard assets? Do you think silver's industrial demand story will define the next decade? Or is this all driven by monetary fears that could evaporate if conditions change? Drop your thoughts in the comments. The discussions here are often more valuable than the content itself. And make sure you are subscribed to Element Axis if you have not already. Hit that notification bell so you do not miss the next breakdown. That is it for today. Everything you heard here is for education and perspective. I am not your financial advisor. I do not know your situation. Use this as a framework, not a prescription. Make your own decisions, and own the results of those decisions, whether they work out or not. Thanks for watching. I will see you in the next one.